tell us more about what's been making headlines in finance and economic news this week, we're joined by Suzanne Haddan, Managing Director of BFG Financial Services. Thanks for coming back, Suzanne.
Good morning.
Some news on the property lending front. What is it?
Well, we've had quite a boom in lending. Investors are back with gusto, up 5.7%. First home buyers are having a proud showing, over 5%. But worryingly, the average loan is now increased to $414,000 across the state, across Australia actually. And that means people are borrowing more, given there's been some changes in how you can service your loan.
Well, when you say $414,000, if anyone is in inner city Sydney, Melbourne, Brisbane or Perth, they'd be thinking, $414,000? I can buy a house for $414,000?
Hey Josh, I would suggest if it's in inner city Sydney, you're borrowing a lot more than $414,000, let me tell you.
But is now the time really to borrow, given that the economy is slowing down? There's a whole global economy that's slowing down as well. Unemployment's still going up?
Well, unemployment, it's 5.3%, well above where the Reserve Bank wants it at 4.5%. I would say you'd have to be cautious in that wages aren't going up, and that's flowing through to consumer sentiment. We have had property price rises in Sydney and Melbourne, but not all around Australia, so people could still buy reasonable price properties in other places. I would say caution, just because you can borrow something doesn't mean you should. And they have changed how they determine what you can pay for your loan, and people now can borrow more.
Does this mean that the property market will start spiking up again?
I think that would be the hope in a limited sense from the Reserve Bank, because they want us to feel confident. And one of the determinants of whether you feel confident and hence go out and spend is, do you feel wealthier? So
the people who aren't in the property market don't feel wealthier. It's this contradiction, isn't it? You want people who already own a property to feel wealthy. That's great for the economy, but it's not necessarily great if you want somewhere to live and you haven't been able to get to the market yet. It's two distinct stories, isn't it? And that's a fine balancing act that the Reserve Bank will need to consider.
I mean, we have official cash rates at 0.75%, and their aim is to encourage borrowing. Whether they want to encourage borrowing just to buy homes, I would suggest not. Reserve Bank wants to encourage us to borrow to invest, for business, to employ people, to grow the economy. And that's the concern they have. Is it going to achieve that?
Okay, so if borrowing's going up, lending's going up, does that mean we're going to see more construction, dwelling, and perhaps maybe unemployment will start to go down?
We haven't seen it yet, Fauziah, but we're hoping to see that more construction, because they're such a huge employer around Australia and it keeps the economy chugging along. But business confidence is down, borrowing for business is down, so the construction hasn't recovered as yet.
And the interest rates, low interest rates, of course, have another impact, which is that if you've got a lot of savings, you're not earning anything on them, and this is the other story that we wanted to discuss with you, that it's hitting retirees.
Yeah.
Ouch, is what I would say there. It is quite concerning. What I would say is that retirees need to consider where they place their money in term deposits. You've got a third of term deposits are now paying under the inflation rate. So you're actually going backwards. But you can get a 12-month term deposit at a non-major bank at 1.95% right now. And the major bank is 0.9%. Shop around. You've got to maximise your circumstances. Remember, the government guarantees your term deposits and cash up to $250,000. So there's no real reason not to shop around at this point.
You mentioned business sentiment is down. Consumer sentiment is down as well. People don't really want to spend as well. But, we've had the tax cuts, we've had the tax refunds, we've had the interest rates slashed as well. How do you get people to spend?
Well, that's the problem, isn't it? It was only up 0.4% in August, but that was after a very flat July. We're being told that we've got to wait a little bit longer for the tax cuts, for the lower interest rates to filter through. But what happens is all this talk of interest rates coming down, potentially negative interest rates, potentially quantitative easing, where Reserve Bank buys bonds from the markets, can spook people and actually make you feel anxious. And you do the reverse of what the Reserve Bank wants you to do, which is shop.
Why are they responding so aggressively to the economy? It must be terrible.
Yeah, what are they not telling us?
What do they know that I don't know?
There's other nasties around the corner that I have to insulate myself. It also encourages people, retirees, back to that group, to potentially take more risk than they might be comfortable with. And so again, you've seen the share markets recover and move up this year. That's a story about lower interest rates and people taking on more risk. Make sure you're pricing what that risk means to you.
In other words, you shouldn't be overextended in the share market if you're a retiree who's going to want to access those funds in the next few years.
Exactly. Spot on, Josh.
Yeah.
Investing in the share market is for the long term, not for the short term.
Is there an alternative that's somewhere between the terrible rates that you're getting on term deposits and the risk of the share market, bonds maybe?
Well, people do go to the bonds that are listed on the stock market. You can buy and sell them. But just remember, in the global financial crisis, those bonds, if they're worth $100, actually dropped in value.
Okay. Thanks for reassuring us. Always good to talk to you, Suzanne.
No problem, Josh.
There's a sunny outlook for a Saturday morning at 7:30.
Thanks, Suzanne.
Thank you.